All right, this is Rich from richonmoney.com, and today I'm going to talk to you about the 5 worst financial mistakes to avoid for military members. But before I get into that, just let me first talk about quickly who I am. Again, I said it already, Rich from richonmoney.com. I have a website where I talk about basically how to kick ass with money if you're in the military or if you're a vet, and also how to kick ass in real estate. But today it's more of a how to avoid screwing up with money and how to avoid screwing up in real estate. So I'm going to basically get into that today. And I'm going to list 5 different ways to avoid screwing up badly. 4 of them are more money related, and the last one's real estate. And I think that one's the most important, just because real estate tends to be where the biggest amount of money is spent. You'll have to forgive me today because I might be a little bit ornery, a little bit preachy. I might get a little bit into it, just because this is a serious subject. And, I've been around for a while. I've been around military members for a while and non-military, and I've just seen too many people screw this up. And so I want to get the point across. So, again, it might be a little bit preachy. But let's dive into it. Now, if this is something that you guys and gals like, please give it a thumbs up and please leave some comments and let me know where you're listening from and let me know what you think. So let's just get started. Let's dive into this. 5 worst financial mistakes to avoid for military members. The first one is going into debt. I'm kind of trying to do these in an order that makes sense. And people tend to go into debt first. That's kind of where they get screwed up. How do they go into debt? You go into debt by living large, right? Living large when you haven't really made that money yet. Spending money you haven't earned yet, keeping up with the Joneses, competing with the Joneses. The Joneses are trying to keep up with you too. Here's some examples of how people do it. Buying or renting much more house than you need. I see it a lot in the military. It surprises me. I'm always kind of surprised if you're there's just the 2 of you, or maybe it's the 2 of you and a baby, but somehow, you decide that you need, let's say a 4,000 square foot house, 6 bedrooms, 4 bathrooms, maybe you figure you're going to grow into it, but if you're going to go several $100s over, your BAH, just because it's got great schools and, I like the neighborhood. I want to caution you to do the opposite. Get the smallest property that will fit your needs. That's no fun. I realize that, but you're going to be so much better off if you do that. Having a new house that's custom built, kind of along the same lines. A lot of people do this. And I think it's just, sometimes we get this sense of an entitlement. I've been in the military for a while. My spouse is working. We're doing well. We deserve it. We deserve this new house. I want to give my wife or my husband the best, right? I think you are much better off living in the smallest house that you can that fits the needs of your family, right? And putting that money aside for many, many other things and putting that money aside for the future. And maybe by the time you get out of the military, you'll have this massive, awesome nest egg, or doing something like that will be much more of a reality. I think sometimes people custom build these houses before the income is really there. And then you got to fill it up with new furniture and nice cars in the driveway because that makes more sense. And none of those things you can really afford yet. Newer, expensive cars. This is a net worth killer. Do not do it. And what I want to say on top of this is military car sales. And then when you're overseas, they'll give you a great deal for a new Volvo, new Mercedes, all these programs that you have when you're overseas for getting a new car delivered to your specs to your front door when you PCS back to the States. Do not do these things, all right? oh, but it's like a special program that saves the military money. No, you're not getting a special deal, all right? You are still paying for a brand new car, and you get killed on appreciation the second you drive it 1 mile. You know, it's getting reduced by 20 or 30% on the first time you turn that and start it up. And it is just a horrible, horrible investment. Do not buy a new and or expensive car. Vacationing while overseas. There's this competition in the military. There's like a Facebook and an Instagram competition. Everybody is just doing these awesome trips everywhere while they're living in Europe, while you're at Ramstein, Stuttgart, where I was. When you're in Japan, there's so many cool places to go, and everybody is going there, and you're seeing everybody else go, and you want to go, and you want to see the world, and you want to see if you can do all 50 countries in Europe. I don't know if there's 50 countries. I'm not good at counting. You know, maybe while you're there. These are bad ideas. Okay, you should, and you want to go on awesome cruises like everybody else. Try to avoid the vacation. Try to avoid the cruises and avoid the vacations that require lots of flying and hotels. These are very expensive things. Take advantage of existing geography. Take day trips. Take trips that are close by. Try to use Airbnb instead of hotels. Try to cook your meals in Airbnbs instead of expensive hotels. And take advantage of the existing geography. Just my 2 cents. I want to give the cardinal sins of debt. Cardinal sins that I just love to talk about because I think they're so bad. Sorry if you've done some or all of these things. Leasing a car, kind of like buying a new car, but almost worse. Never, ever do it. If you've done it, never do it again. Boats and motorcycles. Hopefully you haven't done both. Boats and motorcycles, very, very wasteful, very expensive. Okay, I don't know. Maybe it's just very important to you. But if you're looking to get somewhere financially, I would avoid both of these things if you can. I'll get some hate mail on this from the tens and tens of readers that I have, or maybe watchers in this case. For God's sake, do not ever buy a timeshare. Timeshares are the worst thing in the world. You are prepaying for like years and years of vacations at a overinflated price that you cannot get out of. It is a horrible, horrible idea. Airbnb at your leisure is a much better idea. Do not ever buy a timeshare. You are severely overpaying. End of rant. Next, number one was debt. Number 2 is delaying paying off debt. So you're in debt. I forgive you. Number 2 is delaying paying off debt. Do not delay paying off debt. Here's some examples of this. You've got a bunch of credit card debt. You own a timeshare. You leased a car. You've got a Harley and a boat. Okay, I understand that. But guess what? Now you want to go on a cruise. Now you want to invest in a rental property. You know, now you want to put a bunch of money in the stock market. Well, wait. You shouldn't do any of those things until you start paying this other stuff off. You need to prioritize. Pay this stuff off. You ever heard of like Dave Ramsey's baby steps? Debt snowball. Pick the worst piece of debt you have and pay that thing off first. Knock it out. Then do the next one. Knock that out. Get rid of all the debt. I want you to include your student loan debt too. You don't have to include your primary residence. That's okay debt. It's not good debt. It's okay debt. But get rid of your debt before you start piling other things back on. That's what I'm talking about when I say delaying paying off debt. It's like you're adding things on when you haven't got rid of the other things that you already burdened yourself with first. Number 3 on the list, not maximizing your retirement benefits. Dude, come on. Let me talk to you about this. I think this is a big issue for military members, and I want to stress this to everybody. Not maximizing your retirement benefits, the problem everybody has, they don't understand exactly what their retirement benefits are. A lot of people don't know a very simple fact that I want you guys to be clear on right now. Clear on what it is for everybody, and then clear on what it is for married people. For everybody, this is the case if you're in the military. Everybody can have a TSP account, which can be maxed out at $19,000 a year in 2019, and an IRA account, which can be maxed out at $6,000. And you should do both. You should max out both if you can. And then if you're married, if you have a spouse, your spouse can also max out his or her IRA, whether or not they're working. A lot of times, why my spouse doesn't work, so she can't have one. That is not true. Whether or not she's working or he's working, they can put money in their IRA. So ideally, you're maxing out your TSP at $19,000, you're maxing out your IRA at $6,000, and you're maxing out your spouse's IRA at $6,000 before you're doing other things like investing in a rental property, leasing a car, putting money in the stock market, buying 2 Harleys. You're doing this first. Why? Because it is your legal way to cheat on taxes. Do not skip this. This is your future. This is your retirement, part of your retirement. Now you might get a pension too from the military. Awesome. But you want this too. This is very, very important. Do not skip this. Okay? Maximize your retirement benefit. This is I cannot skip step. It is absolutely super important. Must be done. Don't get in debt. Don't delay paying off debt, and maximize your retirement benefits. These are just must-dos, all right? Number 4, drum roll. Not investing properly. This is a very big mistake that people make. I'm not going to sit here and tell you today how to invest, and I have lots of stuff on how to invest on my website. It's not how to invest that I'm going to tell you. It's what not to do that I'm going to tell you today, because not investing properly is number 4. And I'm just going to tell you is there 4 things under number 4? I think there is. The 4 items under number 4, not investing properly, that I'm going to warn you about. Here's the 4 things within investing to avoid. Chasing hype. Do not chase hype. What is hype? Bitcoin is hype. Bitcoin or things like Bitcoin. If everybody's talking about it, if everybody's writing about it, if everybody's making money doing it, like on a daily basis, if you think you can day trade and make money, then I want you to leave something in the comments, and then I'm going to reach through the screen and choke you. But anything that's hype is kind of like, oh yeah, everybody's talking about it. I'm going to make money around the water cooler, IPOs, newest technology, next hot thing, media all the time. It's hype. Don't do it. You're not going to make money. You're going to lose money. It's too late. Number 2, chasing returns. If you see that everybody's making a lot of money in something, it's kind of like hype, but a little bit different. Sometimes it can be something maybe more legitimate. But you're like looking at a chart, right? Maybe like Morningstar ratings, and you're like, oh look, the last couple of years, this made tons of money. I'll just put all my money here because I made tons of money the last couple of years. That's the wrong way to look at it. Just because something made money the last 3 years doesn't mean it makes money the next 3 years. It could have been because the market the last 3 years was favorable and it's not going to be favorable now. There could be lots of reasons why. You don't just chase returns. You don't just look and see what stock or what mutual fund did great the last 3 years and put your money there and be like, well, it's obviously did great last 3 years, it's going to do great the next 3 years. That's not how things work. In fact, it's more likely that if it already had its good run, its run is over now. So don't chase returns. Eggs in one basket. This is like, if you work at a company like Apple's probably an interesting example. It hasn't like crumbled, right? But if you work at Apple and the only type of retirement benefit that you have is that all your money's in Apple stock, and then through some very strange, stroke of bad luck, about the same time that you decided to retire, somehow Apple went bankrupt, you would literally have no retirement, right? Your money would be gone. That seems very unlikely, But that happened to my financial advisor who worked at a very, very big financial firm called Bear Stearns. Bear Stearns was massive. It was like Fidelity Investments or Charles Schwab. It was equal in size, if not bigger than those companies. And it crashed in the 2008, real estate and banking sort of bubble. It crashed. And my financial advisor lost all of his stock options, which were millions of dollars. He lost it overnight. My point is, you don't invest in one company or one stock. You don't put all your eggs in one basket. Timing the market. You don't want to time the market. What does timing the market means? It means that when things get scary, like what happened in 2001 when the stock market started crashing, or in 2008, I think, when the stock market started crashing. You don't like, oh, the stock market's crashing, so I'm going to sell all my stock, and then I'm going to wait for it to go down. And then when I think it's really low, I'm going to buy back in again, and I'm going to ride it back up. That's called trying to time the market. It doesn't work. If you try to do it 10 times, you'll be successful once, and you'll fail 9 times. What you'll usually end up doing is selling at the wrong time and buying back in at the wrong time and losing more money than you would have if you had just left your money damn alone. Timing the market does not work. Don't time the market. You need to just, if you're invested in a what I would call a safe manner and in a normal manner, you're going to be invested in such a way that when that type of quote-unquote crash happens, you should just leave your money put. Let it crash, let it recover, and just don't touch it. Number 5 on the list. I want to go through these again. Number 1 was going into debt. Number 2 was delaying paying off debt. Number 3 was not maximizing your retirement benefits. Number 4, not investing properly. Number 5 is the most important: buying houses that won't make good rentals. I'm the real estate guy. I'm the military real estate guy, and this is the one that I am the most passionate about. So I'm gonna harp on this one. If this is good stuff today, please give me a thumbs up. Leave something in the comments about what you think about all this stuff. Military members tend to think, as most people do, that wealth is built by purchasing properties and that wealth is wasted by renting properties. That is not true if you're in the military. If you're in the military, wealth is wasted by buying properties, okay? And it is built by renting properties and doing all the other 4 things that I just talked about. You are usually worse off buying properties in the military because you're moving every 1 to 3 years. And that life doesn't lend itself to buying houses, okay? There's this weird myth in the military that if you buy a house at every duty assignment and then retire, turn them all into rentals, you're going to be wealthy. That's wrong. You're not going to be wealthy. You're going to be poor. Why? Because most of the houses you bought end up not being good rental properties because you didn't understand the concept of what makes a good rental property. I'm going to explain that to you now. If you've read my website, you probably already know this. The 1% rule is very important here. The 1% rule is as follows. If you buy a property and that property can rent for 1% of the purchase price plus the fix-up price, in other words, the acquisition price, if it can rent for 1% or more of the acquisition price, then it would probably make a good rental. Not a guarantee, but probably make a good rental. Example, if you buy the house for $90,000 and it just needs $10,000 to get fixed up, acquisition price of $100,000, if it can rent for at least 1% of that, $1,000 or higher, it might make a good rental property. Now, if it's going to rent for less than $1,000, it's not going to make a good rental property. That's the test you need to give to properties that you're considering buying while on active duty. Now, if you're in Hawaii or Los Angeles or New York City or San Diego, you're not going to pass the 1% rule. Don't buy a property. it is going to be a poor investment. That's what I'm telling you guys. Buying houses that won't make good rentals while on active duty will lose you lots of money. Come time to move away, you're probably not going to have enough appreciation to make a difference. You're probably going to potentially lose money if you sell. And when you turn it into a rental, you're going to think you're breaking even or making a couple $100 a month. But when it comes to expenses that you really don't quite understand, you're actually losing money. You're losing money because you're not really calculating all the expenses that occur throughout the year that you're not necessarily seeing, like the insurance and the tax and the maintenance and the deferred maintenance, HOA. There's just a lot of expenses that just creep in there that are on top of the mortgage that you're paying every month. In fact, they say that 50% of what you get in rent ends up being eaten up by expenses. So anyway, don't buy a house unless it'll make a good rental property. I'll just say it simple like that. So that's it. In conclusion, stay away from the big debt traps. Prioritize getting out of debt. Maximize your retirement benefits. It's a legal way to cheat on taxes. Make sure you're investing properly and only buy real estate when it makes financial sense. This is Rich Carey signing off.